So it looks like our real estate market or the housing market is completely out of whack right now. There's differences in opinion, differences in statistics. It's the way you look or read things. It's tough to figure out what's going on. And by the way, today is also Case Shiller Day. So we're going to talk about that and more. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is the 27th of June. It's a Tuesday, last day of the month. Month has gone by very quick. Randy Patrick here, putting the realism back in real estate. Yes, I've not been doing a video for or maybe for a little while. Why? Because I'm busy doing real estate deals and being out in the field, etc., etc. A lot of stuff happening here, a lot of cool things. So, obviously, news of the day: the last Tuesday of the month, Case Shiller statistics is released. The Case Shiller National Home Price Index is a we'll call it tag-along, drag-along type of calculation analysis. So even though we're at the end of June, we're going to be talking about April's data and some more as time goes on here in the video. So U.S. home prices surge in April. All 20 cities see gains as rates dip. So what we're seeing here is that whenever there's a change or lowering of mortgage rates, interest rates, the response is more people buy properties because there's a little bit of break in what's happening, and therefore we see more activity and we see a bit of price increases. So there's been some price increases. Again, we're not talking huge. It rose 0.91%, so 0.9% month to month. So April compared to March. All right, the biggest month to month jump since May 2022. So keep that in mind because things play out a little differently, right? So the National Home Price Index actually went down year over year. It went down for the first time since April 2012. So it actually lost. Now, it lost a minuscule amount as well, too. On a trailing 12-month basis, the national composite is 0.2 or 0.2% below its April 2022 level. The 10-city and the 20-city composite indices also had negative year over years as well, too. So you got to keep all that in mind. So, of course, we take a look at what was produced on Case Shiller today. S&P Dow Jones Case Shiller, continued its gains in April. So when you see that word, you think, oh my gosh, we had gains. Well, we don't have massive gains. So the month-to-month gain was less than 1%. That's the scoop. Typically, Miami, Chicago, and Atlanta reported the highest year over years. If we go back a couple years ago on this type of report, we would see Phoenix or Tampa with 33% or 32% or above 30% year-over-year increases leading the pack. Well, now we have Miami, who is leading the pack on year-over-year increases at 5.2%. So things have changed over the past few years in real estate. There's no doubt about that. So obviously, there's little changes in the indices, the 10, 20, and national. Ultimately, in the end, on a trailing 12-month basis, the National Composite Index is 0.2% below its April level. Again, just either going back to Miami gains, etc. It seems that properties in the West, okay, we're talking the worst state performers are all in the Mountain or Pacific time zones with Seattle, San Fran at the bottom. The Southeast continues to be the strongest region, whereas the West remains the weakest. So there is where we got going on with respect to that. You can read that. You can download this at their website. So if you take a look at their, the graph they have, which is all the way back from 88 to where we are today, from the left to the right, we can see that in 2019, 2020, we have exponential increases in property values, and we have exponential decreases in what's going on. So again, a little bit of up, a little bit of increase or decrease doesn't seem to make a difference right now. Obviously, the middle hump on this is the chart with the 10, 20, and national indices. So obviously, the middle hump in the graph is the 2006 housing peak, followed by the trough in 2012, followed by the peak, which is really 2022. We've dipped a bit, and then there's a little bit of an uptick based on what's happening the past couple of months. I don't think that trend will last very long. If we take a look at the chart here, from the right-hand column gives us the values from the previous peak. So current peak compared to 2006 housing bubble, or its peak, were 63.1% greater than we were back in 2006. So obviously 2006 in July was our peak, and February 2012 was our lowest point in the trough. But point is, if you bought in the trough and where we are today, you've more than doubled your money. So you should be happy about that. Let's go and look at the actual individual locations here. So Atlanta up 3.5%, Boston 0.9%, Charlotte 3.4%, Chicago 4.1%, Cleveland 2.9%, Dallas negative at 2.9%, Denver negative 4.5%, Detroit 1.1%, Las Vegas 6.6% negative, Los Angeles 3.2% negative. Miami was the leader at 5.2%, increasing. Minneapolis remains stable at 0, so neither up nor down. We have New York at 3% up. Phoenix lost 6.1%. Portland down 5.2%. San Diego down 5.6%. San Francisco down 11.1%. Seattle down 12.4%. Tampa, we're slowing down here at 2.4% increase. And Washington, 0.5% decrease. So roughly, well, that's the numbers. 10 of the metros on the index, the 20 top city index, increased in values. 10 decreased in values compared to the year over year change. That's what I look at. I don't look at month to month because that's pretty, if you want to micro manage the numbers, that's great. But year over year, we're still dragging down. Obviously, the 10 city was negative 1.2. The 20 city was negative 1.7. National was negative 0.2. All right, so we are seeing a slowdown in the real estate market for various reasons. And notably, the bounce in the highly lagged Case-Shiller home price data occurred as mortgage rates ease lower. They are now back to recent cycle highs above 7%. So yes, when things drop a little bit, housing activity picks up. We see more loans being originated, more homes going under contract, getting the closing, etc. And then we see a slight uptick. And then when the rates rise again and stabilize at the higher levels, we see the slowdown. So it basically is it's the, how can I put it? The correlation is there, right? Lower rates means more activity, which tends to be a result in a little higher price point or uptick in price point. So nothing to get truly excited about here. And one thing I do want to mention, and this is interesting, all right? So the man behind the home price index, which is Robert Shiller, who's the co-creator, of course, of the Case-Shiller National Home Price Index. This is, I guess you could say about a month ago or 2 months ago that he had an interview with CNN. I would extrapolate the downturn somewhat. It's going to continue, he stated. Maybe if you have a good chance to delay your purchase, it might be a good time to do it. It might get a little cheaper after another 6 months. So certainly not the normalization the Fed is looking for in its aggressive tightening. And that's why I always say when we see these very small upticks in value, I know the mainstream media and the masses are going to run to say, oh, housing market, the decrease is over, everything is looking great, it's going to be all, everything going upwards or increasing from now forward. Well, that's going to be what the narrative in the mainstream wants us to know, wants us to believe, and wants us to buy into. But when you got the co-creator of this index, or these indices, I guess you say plural, he's basically saying, it's probably going to get a little cheaper. As I've always mentioned, he doesn't say a lot, and when he does, he's not really clear about it. He's somewhat ambiguous, and he's never going to call a crash or a major adjustment or a correction, but he's saying in his terms, and I've gotten used to this over the years of how when he's rarely interviewed, what he does say, you have to read more into it. It might get a little cheaper after another 6 months. So he's basically saying, wait if you can. Now, the housing market, everybody that's involved in the housing market, real estate agents, lenders, mortgage companies, mortgage brokers, all the people that, have their income tied to the housing market, obviously don't want to hear that. They want you to keep buying and keep moving properties, right? Because the money makes the world go round. But if you're an astute buyer looking for an opportunity, again, what the guy who probably understands this index or the number or the market better than anybody because he created the indices, is saying wait. So again, take it for what it's worth. He knows that there's going to be some changes coming in the next little while. So, folks, if you enjoy the data that I present here on this channel, if you could do me the great honor and hit that subscribe button, I'd really appreciate that. And if you're a current subscriber or think you are, if you could do me a favor, smash that subscribe button again. Hit the bell notifications because I lose subscribers every day for various unknown nefarious reasons. All right. So getting into this right now. So that's Case-Shiller. So we're seeing basically half the metros losing, half, some maintaining, some having very small increases. All right. That's existing homes. U.S. new home sales unexpectedly explode higher in May. So this data comes from the BLS, the Bureau of Labor and Statistics. New home sales have been dramatically outperforming existing and pending home sales as low inventory send buyers into the arms of incentivizing home builders. However, expectations were for a 1.2 month-over-month decline in May, but instead new home sales exploded 12.2% month over month. Oh my goodness. Now, we have to qualify this because this statistic gets reviewed and readjusted all the time. So what looks great now, I can tell you next month they're going to readjust the numbers. It's the third straight month of month over month gains, and sends new home sales up 20% year over year. So new home sales completely decoupled from existing home sales, now at their highest since February 2020. So again, numbers can change. They're going to get readjusted. Median home price is $416,300, which is an increase from last month, but only after huge downward revisions from the past 4 months. So that's what happens. Once the data comes in, everyone's excited and produces the data and talks about it. Then the real data comes in and they analyze it a little differently, or they get better data and they do their backward revisions, which things usually don't look as good as once presented here. Housing activity has been a resurgence in this marketplace here, as anticipated by a very simple leading indicator, the change in level of mortgage rates. So while longer term yields are still much higher than they were a few years ago, they've essentially gone nowhere for the last 9 months. Thus, the change in mortgage rates have been falling. It's been enough to give housing and other interest rate sensitive sectors such as autos a boost, but that impulse will soon start to fade unless yields and mortgage rates start to fall. So again, things jump up when mortgage rates jump down. It's completely attached to one another. That's what happens. But again, this information will look worse when they revise this. So again, a lot of stats. So we've had Case Shiller, we've got new home sales, and last week NAR put out their information. National Association of Realtors obviously put out their existing home sales report, and this would be for May. So even though Case Shiller runs 2 months behind, NAR and the new home sales stuff are a month behind. So total existing home sales seasonally adjusted are at 4.3 million. It's actually maybe a little better or about the same as the previous month, but we're still lower than we have the first part of the year. Obviously the peak was in 2020 at 6.56, so we're down over a million, two from that point in time. That's how they look at it. If we take a look at what's going on in the existing home marketplace here, the median home price is $396,100. That's sort of been stagnant. Existing home sales median price has been dropping a little bit. So we've seen year over year increases. Now we've seen the past 3 months of year over year decreases. So it's stagnant. It's actually losing a little bit. 4 months ago we saw no increase. Now we're seeing year over year monthly increases, albeit 3.1% is not huge. The trend is going from 0 to 1 to 2.4 to 3.1. The trend is showing the median price points are starting to drop across the board here. Existing home sales percent change year over year. You can see that we had 20.4% less home sales activity compared to the previous year in 2022. Realtor Confidence Index survey, a little uptick in first-time home buyers, less sales to investors, cash sales about the same, days on market a little bit higher than before. Interesting to note here where the red arrow is, distressed sales have been the same at 1 or 0. Well, this is the first month in a while where we've seen an increase. So instead of having a 1%, we've seen a 2%. So reason being, we're seeing a few more foreclosures and short sales come into play now. So the eviction moratorium, the foreclosure moratorium's over. So lenders have been getting back in the process of actually going through foreclosure filings, etc. So at some point in time, we would expect to see REO sales, lender-owned, bank-owned property start to increase, a few more short sales here and there. So we finally saw a month where it did increase as opposed to virtually nothing. Now, I can tell you in my neck of the woods, no short sales are going on because no one's just doing them, all right, except for me, of course, here. Percent change in sales from a year ago by price range. Well, obviously, we can see that the 500 and above segments, the 500, 750, and then greater than a million, are seeing the greatest amount of change in sales. It's negative. There's less going on. Clearly, that's going to be a result of less cash buyers wanting to purchase, more people who are buying with mortgages, who are going either we're not going to pay that hefty price, or with high interest rates, we can't afford those high prices. Can't have high prices and high interest rates. when carrying a mortgage. Simple as that. But again, every market segment had less sales activity. Obviously, the less higher skews the numbers with respect to median price point and things like that. I do think that a lot of the higher end has been propping up the numbers on the median price point. So we'll see the reverse of that taking charge right now. Going back to volume. So we talk about volume in real estate not in number of units, which is kind of interesting. We talk about it in terms of time. So end of May, we had 2.8 months worth of supply. We have about 3 months worth of supply now across the board nationally for the month of June. So how this works is that if no new properties or listings came on the local MLS, because remember, this is information that's coming from the National Association of Realtors, which means it's pulling and gathering the data from all the local multiple listing services across the country. So if no new listings came on the local MLSs, it would take 2.8 months at the current rate or sales pace for all those properties to get to zero, to have no properties. That's how they measure real estate activity and volume or inventory out there. Now, the real estate gurus, pundits, Weber analysts say that if you have 6 months worth of inventory, that tends to be a balanced market. You have the right number of buyers, the right number of sellers. The market's not skewed in any direction. We happen to have low inventory. So, you would think that, it's still a seller's market that's out there right now. But in a way, it's also a bit of a buyer's market because, the buyers who are qualified or the buyers who are going to buy, they're being very picky and choosy about what property they are going to buy. Because when they have low inventory and high interest rates, they have to get better deals or better value for their money. So even though I guess you could say from a numeric statistics point of view, it's a seller's market, but I'm betting that, from a real point of view, if you've got your property on market sitting there, days on market are increasing, you had to reduce your price point a couple of times, you need to be attracting the buyers who can actually afford or qualify for that mortgage that can afford to purchase your property. That's where we go with this. So new home sales, they didn't talk about it in that analysis, but new home sales was earlier this year at about 11 months worth of, a little over 11 months worth of supply. I think we're into that 7-8 months right now. So we are seeing that change. Now realize that new home, sales, so obviously the builders and things like that, they're large, they have a lot of economies of scale. They can offer incentives, they can offer more value for your purchase with respect to upgrades and things like that. They also can buy down mortgage rates, etc. So they're highly incentivizing the new home sales market, which shows that they're having more success than the existing home. Obviously, NAR, National Association of Realtors, is dealing with the existing homes they're listed with a real estate agent. That's the scoop that we got going on right here. So again, we're about 50% where we need to be as far as inventory is concerned on the housing market. So we'll see what happens here. So anyway, guys, lots going on here. There's so much happening in this marketplace, really great opportunities. Foreclosures are picking up. They are. More bank-owned are coming on the market or becoming available. Short sales, listen, I'm doing more short sales. Simple as that. We're getting great deals on our short sales. Subject to, you can pick up property subject to existing mortgage. Lots of other foreclosures out there. A lot of neat things that you can do in the real estate market. We're involved in pretty much all of these, we'll call it niche, sub-niche markets under the overall foreclosure umbrella. So if you want information, you want to get some training, join my program, get some coaching and mentoring, whatever you want to do, feel free to reach out to me and I'll talk to you about what we got going on here. The opportunity is quite interesting because we're seeing a gravitation towards this. Obviously, I got some special offers going on now. Held an event locally here in Tampa at a meetup, sort of collab incubator office that I hang out at. And you can see that the everyday person now is realizing I can't afford these properties at these rates. I need to look for alternative methods to get my hands on discounted or cheaper properties. I can show you what to do. So just please keep that in mind. As much as the mainstream media will tell you, everything is great. Well, it's great. It's okay, I guess you could say. But the foreclosure volume has not hit. It's not manifested. That's actually being, sort of controlled behind the scenes. We're seeing a little bit of it sort of squeak out now. Things will change over the course of 2023. Remember the infamous words of Robert Shiller, you might want to wait about 6 months because prices are going to go down. He didn't say how or why, but he's envisioning that the market will change. So once again, everybody, thank you for the views, likes, and comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe. We'll look forward to speaking with you before the week's out. Take care.